Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello, and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management, here today to talk about a lot of different things on the Smart Investing Show. We're going to cover some important topics today, short-term rentals on the real estate side. Why not talk about that? Also talk about young investors and big changes there that's going to take out maybe $100 billion from the market. We'll discuss that. And then, well, this is the big weekend, Super Bowl weekend. We'll talk about Super Bowl betting. Is it better than stocks? Chase, what do you think?
Well, I guess it depends if you win.
Yeah, true.
Also, too, if you do want to join the show, again, phone number here, 833-288-0973. Again, that's 833-288-0973. You got a stock you're thinking about buying, perhaps, maybe selling. We'll break down those fundamentals and give you our opinion on what that stock looks like.
And, kind of start off our topics here, talking about real estate. And we've been talking about real estate for a while. And there's certain real estate we think is good, certain real estate that we don't believe is good, because it's just, when you look at a graph, it's just like it goes out about, kind of bumps along normal way, ups a little bit. And then 2021, it just took like a major spike up dramatically. The returns were unbelievable compared to the past. And that's just not sustainable. So we try to let people know what's going on. And we got another reason that we're kind of concerned on real estate, and it's about short-term rentals. We have talked a lot about the affordability problems when buying a new home. But one area we haven't discussed as much is the real estate investor. The short-term rental craze, I believe, created new investors who thought it would be easy to make money in real estate. Looking at the numbers, in 2021, investors made up 24% of single-family homes, and in the first half of 2022, that number was still around 22%. Now, this compares the range of 15 to 16% annually going back to 2012, just 10 years. Now, unfortunately, things have started to change in the short-term rental market. According to Wall Street Journal, one investor in Encinitas was able to rent her two-bedroom condo for $1,000 per night on a holiday weekend, but she has had to drop her rate to, $275 per night due to lagging demand.
The problem is not the demand, but it actually comes as well from the oversupply. I mean, that's a major issue there when you look at it. In fact, nights stayed were actually up 21.3% in the month of October when compared to the previous October. So again, you're still seeing Airbnb, the VRBO, those short-term rentals. People are still interested in going to them. But the big issue is listings surged 23.3% during the same time frame, and there were 66,000 new rental properties listed in the month of October alone. I mean, that's a huge number. Again,
huge,
it's a factor of supply and demand is what it comes down to. And the thing I look at is with rising interest rates and lower rental rates, it becomes a whole lot harder to justify an investment in these properties, and some prior investors could become at risk of not being able to keep up with the cash flow required to maintain the house. I believe this will lead to less demand in the housing market and a potential source of supply if investors need to sell underperforming properties. These factors could help bring down home prices even more.
And unfortunately, many people, when they invest in stocks and in real estate, they look in the rearview mirror. Oh, well, it's done this, it's done that, so I want to get in now. And their emotions drive their decision. What we try to do is break down not what's happened in the past. Well, we look at the past to say it's not going to happen in the future. And when you have, more people trying to get into these, and again, it's not a demand factor. The demand is there, but the supply is really large now. What I'm thinking, what if in 2024, demand slows down, where people say, I'm not going to travel as much this year. I've done a lot of travel the last 2 years. And also, too, we didn't look at this, but what about the hotels? Are they building new units as well? Because they're all competing for that same traveler. So that could be a problem.
And the issue, I look at it in the short-term rental area, is I think there's going to be successful short-term rentals, but you have to make it a unique experience. And I think a lot of these investors just thought, oh, wow, I can just buy a house and then the short-term rental rates will cover my mortgage, my insurance, and it was for a little bit. And perhaps I've heard people that were cash flow positive on them. Even after all those expenses, you're like, wow, I'm making money and I'm paying off my mortgage at the same time. This is great. Problem is, now that may not be the case. Those people that were cash flow positive may be cash flow negative. So all of a sudden now you're sitting there with this real estate, and you're like, do I keep sinking money into it, or do I just eat it, get my money back out of it, and say I'm out of this short-term rental market? Or perhaps you look at converting it to a long-term rental, but then your cash flow still will take a hit. So there's so many different factors that I think people are going to have to consider when actually looking at maintaining these properties. I think it's a big factor that people aren't necessarily talking about as much.
And actually, people do have short-term, foresight, because when you look back at 2008, I mean, everybody knew that real estate was going to go back up, but people just walking away from their homes like, I'm not going to pay this any longer. I mean, we all knew that, probably 5 years, it's going to come back, but people had that attitude. Well, I'm putting money in this every month, and I'm not making anything. I'm just going to walk away. I'll just sell at a loss, whatever. And it's just something that we worry about, too, that people maybe got over-leveraged with it as well. Yep. So did they make a smart move by buying that property? And again, property can do well for you, but you got to get a good price. You can't be over-leveraged.
And the other thing you look at, too, is just the cash flow. I was saying maybe you went from being cash flow positive and now you're having to pour cash flow into it. Well, what if you can't afford that cash flow into the property? Yeah. That's, again, where there's an issue that ensues. So, I mean, I just look at it as an area of really no strength. I don't think it's going to be as profitable as it was because there is more on the market. Plus the rising interest rates. Now that means mortgages are more expensive. So then your cash flow for new investors is not going to be as good. So that's not going to necessarily incite demand as it did the prior couple of years, because people are like, oh, wow, I heard my friend Bill, he could actually go buy a house and, he's making all this money on Airbnb. Now, is that the case anymore? I don't believe so. So that's a huge problem on the demand side. And also, too, outside the short-term rental market. I was actually driving over here thinking, I know we were talking about this morning, was the flipping market. I can't imagine the flippers market is doing very well right now. And I know there's some, I'm going to say, more seasoned and well-established flippers that know actually what they're doing.
Right.
But again, you could buy a house back in 2021 and think you're adding all this value to it, when in reality you could have done nothing and the house was going to go up anyways.
Well, and that's what I was going to say. Flippers, I've done all this, making all this money, flipping houses and so forth. Well, I may have done the same thing. I just held on to it. And my thing is, unless you're putting something into that house. Now, if you get a house that's kind of run down a little bit, you put some sweat equity into it, you make it better, you increase the value of that home, well, then you're a smart flipper. But just to buy a house and then turn around and try to sell it at a higher price, you probably could have done better just holding. Like people that trade stocks. Same thing. Oh, I'm making all this money trading stocks. And many times you would have done far better just buying a good quality business and holding on to it for that time frame.
Yeah, and I think that is something that happened in the real estate market. Is I think people got overconfident, over cocky, and that brought in a whole new type of investor over the last couple of years. And they thought they were providing value. And in reality, as I said, you didn't really have to do anything. Real estate was just going up, and those are going to be the people, unfortunately, that are going to get burned here, I think, over the next few years, as they think they know what they're doing. And in reality, they don't. They were just a beneficiary of the strong real estate market. And now all of a sudden the real estate market's not as strong. I think you're going to see the investor portion of the real estate market start to decline as well.
And we're going to talk about young investors in a minute. But the other thing, too, is that young investors that got into the real estate market, I'm going to get a couple B&Bs, I'm going to do great and so forth. I believe some of them also like, wow, I'm a real estate, mogul now. I'm so great. I'm going to go out and buy a new Mercedes. I'm going to buy a new Porsche. So now, not only do they have the drop in the cash flow and the income, now they've added a new payment for a car that is probably worth less than they bought as well. So it kind of stacks on itself, and it creates that problem. So let's actually talk about the young investors, because across the nation who experience big losses in investing are now pulling away from investing in stocks. Goldman Sachs estimates households will pull as much as $100 billion in 2023 from the stock market. Now, this will hurt companies like Robinhood, who encouraged young traders to do a lot of trading. Back in March 2021, Robinhood had as many as 4 million trades per day. That's 4 million per day. That has now fallen to about 1.2 million trades per day. I personally think this is a good thing. Many young investors just thought they could buy anything and it would go up.
And then they also started using leverage and options, which magnify the risk, and that ultimately costs them even more. I've said for years, if you've averaged around 10% on your money over a 7 to 10 year period, you're doing pretty good. Unfortunately, some younger investors laughed at that, and now they have nothing left. And worse than that, they won't come back to investing for many years, missing out on some good growth over the years to come. Investing takes a lot of work, and it's not something that can be done quickly by trading stocks. There are very few people who can invest over the long term, as their impatience and lack of discipline cost them good results.
Yeah, this is just something that you think you know something. And I've said it could last, a month, could last 6 months, could last 6 years. But you don't know anything. And you said, well, the real estate market, you're at the right place at the right time. It's nothing that you really added to it. You weren't, you just weren't smart about what you were doing. You were lucky. And then when that luck runs out or the market changes, you don't have any idea what's going on. And where we got this from was the Wall Street Journal. And there was a gentleman that he had made like up to $1.5 million. He's like 25 years old. He thought he knew everything. He'd go into the casino and he'd buy like what he drinks, and he'd spend like $30,000 on betting on football games. He thought he was set for life. Well, now today he works in a deli in Las Vegas because he lost everything by gambling. And when you're doing the options and the trading and all this other stuff, margin, you're gambling. You're not investing.
Well, and again, this is the big mistake that people make, is you can do very well for, let's say, a 2, 3, 4, 5 year period even. But if you don't know why you did well,
right,
and you think you're hot stuff and you know exactly what you're doing, but you don't really actually understand the philosophy or, again, why you did well, you don't realize that a 90% loss, very realistic. That can happen to you in high-risk things. So let's just say, wow, you've built up, again, like this gentleman here, you've built up $1 million portfolio over a few-year period because you got lucky on some great trades there. You maybe bought GameStop, or you maybe bought the AMCs, and maybe you did sell out at the right time.
The meme stocks. Remember? Yeah, that's probably what he was doing. Yeah.
And then what happens is all of a sudden you buy the next thing. Maybe you buy into a Bed Bath & Beyond, let's say, as you're trying to get into that next meme stock, but you buy too high. Or you buy back into the AMCs. And then that stock falls 90%. Well, your $1 million is now, let's say, $100,000.
Right.
You've wiped that out. But the big problem is you've completely changed your lifestyle because you thought you were worth $1 million.
Right.
Now you're not.
Right.
Now what do? And that's the big problem that people run into. And that's why the consistency, and again, why we do the value investing, and it makes so much sense, is that compounding growth in the long term is so beneficial because you're not taking those highly leveraged risks that can completely wipe you out.
Yeah, and you just have to be smart about what you're doing. And unfortunately, and this will happen over and over again because young people, they don't have the experience. I always talk about the wisdom. You got to have the wisdom, and that comes over time. In my beginning years, and actually I really started looking at stocks, so I was like in the 7th grade. Didn't know crap about anything, but it's just like, but that's when I started. And I made some mistakes when I started investing because I didn't know what I was doing. So you have to learn. The problem is with the young investors of today, they got really lucky during the meme stocks and the COVID and so forth, and didn't realize that was just an anomaly. It's not going to happen again for years to come. So,
and the other big issue I look at is, again, that overconfidence that starts to kick in. Maybe you start trading stocks with $1,000, and you're like, oh, you get lucky on one trade. You're like, I know what I'm doing. Your next one, I got $10,000. Yeah, I know what I'm doing.
Right.
Get lucky again, let's say. Third time. Let's just say now you've built up a nice portfolio, you got $100,000. Yeah, I know what I'm doing.
I know what I'm doing.
And the problem is you start to build this overconfidence, like this gentleman that was pointed out in the Wall Street Journal with $1 million portfolio. It's like, I know exactly what I'm doing. And it was just craziness that kind of built this house of cards and completely wiped him out. And that's the big issue of investing, is things can change much quicker than people realize. The meme stocks, they're a fad. Right. There's going to be other things. We've talked about 3D printers. We've talked about pot stocks. I saw the Canopy Growth go across the ticker screen the other day, and I think it was like $2 a share or something.
Is that a high up? Do you remember?
I think that one wasn't as bad, but it's still like $40, $50 a share. I remember.
Well, from 40 to
yeah,
40
but
down to 2
I think I think Tilray was like in the hundreds or 200s. Really? That one was really bad. So, I mean, I say you've lost again a lot of money, more than 90% of it, with that type of decline.
And we talk a lot in the office and so forth. And we were just talking the other day about how value investing will never go out of favor because it just is common sense. You have a company earning $1 million a year, and it's trading for, these numbers aren't going to match up at all, $10,000. Well, if it drops down to $5,000 and now it's still only the same $1 million, or maybe even $800,000, that's a value there. You're getting earnings, and you got to check, and that's what we do here. We check for people when they call in, which I'll give the numbers in a minute, to check to see, am I getting this business on sale? So that's what we're looking for. And as long as you have earnings and cash flow and sales and all these things, you can find something on sale. But to try to predict what's going to happen down the road, like, oh, they're going to have this here and it's going to make all this money, yeah, that is so hard to do. And it is more of gambling. I think you might have the better chance of, well, maybe not the lottery, but it's just very hard because you can't see what that company's going to do for marketing. You can't see what's going to happen with their cash flow. You can't see competition coming in. Maybe the product causes cancer. I mean, all these different things that you can have happen where when you buy, we'll just say a food company that is down 20, 30%, it's like, wow, and those earnings will come back and it's got a strong balance sheet. That makes sense, and that will never go out of favor. You're never going to make, well, and actually in 2021, we actually did very well because of COVID. Was it
2021 we did
2021,
well.
yeah, we did extremely well. But it's not like, oh, wow, we're really smart.
We did 70% this year.
Yeah. and we didn't do 70%.
No, we did not do that.
Right, we're not telling you what we did. We did extremely well above market averages. But it's just like we knew that was a one-time thing. It's not like, wow, we are so smart. We're going to do this every year. We'll be billionaires by 2025. You know?
Oh, like Kathy Wood's annualized growth expectation of 40% per year.
Yeah, you know, and I think Warren Buffett's famous for long-term, I think earning over 20%.
Yeah.
So, and yeah, to say 40%, that's just hype. That's what it is.
And you know, I was reading about Warren Buffett the other day, and it's actually all he really is a big insurance company, and then he's taken those insurance premiums and then invested them properly.
Yeah.
I mean, that's one reason we love insurance companies is because of the cash flow that's generated from those premiums, and they have the risk analysis to make sure they're not getting themselves in a sticky situation. All of a sudden, they start to lose money. Well, guess what? They raise the premiums. It's a very, I'm going to say, it's a complicated business, but it's very simple to understand the business model of it, which is what we love. And then that's kind of, I think, what Buffett saw years ago with a company like Geico, let's say. And now he's got those insurance premiums, and that rolls into his investment portfolio where they now invest those premiums into, you know, those stock picks. I know he's famous for the Coca-Colas and the banks and so forth that he's done very well on. It's an interesting model. And
he also likes the cash flow of the dividends. Mm-hmm. And he doesn't reinvest the dividends into that company. He used those dividends to buy other companies and keep investing that money. So he likes the premiums. He likes the cash flow from the dividends. And it works out long term. And it takes a while to do that. And when people come over and invest with us, we say, you know, you should be investing for at least 3 to 5 years.
Yeah.
And if you're looking for a 2-year time frame, we're not too excited about that.
I mean, if you're going to need the money within 2 years, like, I'm not a big advocate of, you know, the 2-year treasury or the 6-month. But, I mean, if you need the money short term, those rates aren't bad.
No.
I would never invest long-term money into them.
Right.
But I think if you are maybe looking at buying a house in a year.
Yeah.
Yeah. I mean, there's different things you can do perhaps with opening like a credit line against the account and S block or something. But that takes a lot more, I think, complexity and understanding of it. Right. If you just have a kind of pot of money and you're like, yeah, I want to buy a house in a year. Yeah, I mean, it makes sense to you do that 1-year treasury, let's say that 1-year T-bill. But, you know, I think people just get too cute with things sometimes.
Right. And you should never go into a 1-year treasury just because your emotions, you're afraid of the market. Never do that. Never do that. If you're a long-term investor, look at some good things on sale. Let's go with the phone numbers here. You want to call in for that unbiased, no strings attached, fundamental opinion about what you want to talk about. Phone numbers, 833-288-0973. Again, that's 833-288-0973. Well, let's move on because this is Super Bowl weekend, and Americans excited about Super Bowl betting this year. A record 50.4 million Americans are expected to wager bets on the big game this Sunday. This is a massive 61% increase from last year's record of 31 million Americans that said they would place a bet. In terms of the dollar amount this year, it is anticipated there'll be $16 billion worth of bets on the game, which is also more than double last year's $7.6 billion.
And then from a financial standpoint, of course, got to relate it back to that. I must say this is a positive for the economy as consumers clearly have enough confidence and comfort in their financial situation to place those bets. You know, personally, I won't be partaking in any bets this year. I highly doubt you will. as
I
well.
will not. No.
Most of the time I do the squares. I haven't won the squares in years, but I don't even think I'm just having a couple friends over for the game. I don't think we'll have enough people to do the squares.
I'm usually the guy that does the squares because, it's getting close and there's empty squares and nobody wants to play more into it. Like, okay, I'll fill it up. So we got the thing going here for you. But, I do it because I have to do it to keep the party going.
But as I said, I don't even think I'm going to do that this year. But the other thing, too, that we want to point out is one thing that will be missing from this year's Super Bowl is those crypto commercials, especially from FTX. I don't think that you'll be seeing any from Sam Bankman. I've been calling him Sam Bankman Fraud. As of
Yes.
late. He won't be making any appearances this year.
No, Tom Brady promoting FTX, which he did. They ran that commercial, and oh my gosh, it's terrible. Like, oh yeah, this is very safe. Oh, this is good. Like, oh, it was terrible.
That's rough. Yeah, very, very rough. So, and another one too that they pointed out that was in Super Bowl last year, Carvana.
Oh yeah, Carvana from 300 to 3.
Yep,
I think it's not
rough.
quite that bad, but
Yeah. It's not good. I'll tell you
not
that.
good at all.
As for my pick for the game, I'm going to go with the Philadelphia Eagles there.
I think a lot of people agree with you on that.
I saw the odds right now. Actually, it's supposed to be a pretty good game. They're split pretty evenly.
Yeah.
So I think it's always based. I don't know how they get these numbers sometimes. So when I was reading the article with a lot of the numbers there, it said it was like 44% and 44%.
Wow.
And I was like, yeah. And I don't know. There must be a margin of error or something on it. I'm like,
Right.
that doesn't add up to 100%.
Right. And my knowledge of football, I think I heard that the Eagles have a very strong secondary.
They have a very good defense. They have a very good pass rush. Could challenge Mahomes. Mahomes has a bum ankle. I like to see just kind of Jalen Hurts, who's the quarterback of the Eagles. He's got a cool story. I always kind of look for that. Mahomes has already won one. He was a first-round pick. He's been in the conference championship, the Super Bowl several times. Jalen Hurts, he was the Alabama quarterback, and he got benched, transferred to Oklahoma, kind of made a comeback, was a second-round pick. So I kind of like his story. I think I'm going to go with the Eagles there. I think that's it's got a better story to me.
Yeah.
And being a ex-Chargers fan, you just always didn't like the Chiefs.
Yeah, it's true. Yeah, the Chiefs are always kind of like the rivalry, so to speak. Like, oh, we don't like the Chiefs, so it's hard to kind of go with them. But the Eagles, I grew up. I remember when I was a young kid playing football, I always wore a Eagles helmet. The backyard football. I wore the Eagles helmet. So,
I remember I used to love when they had like Donovan McNabb and Todd Pinkston was a receiver and Terrell Owens was on the team years ago. And so I kind of got that affinity for the Eagles. So I'm not saying I'm a big Eagles fan. I'm not jumping on the bandwagon by any means, but that's my pick for the game, I guess.
Well, that's enough of sports talk for us. I mean, we're not the sports commentators here. We look at the numbers side. But if you want to, the newsletter, because the newsletter has those topics in it. We do this every Friday. It's been very popular. We also talk in the newsletter that went out on Friday, the Eurozone, the unemployment rate, AI and home prices. We also talk about auto insurance, what's going on with that, movie theater, post-COVID, daycare, many different things that make you a smarter investor. It is a free newsletter. What you need to go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Right in the middle of the page, you'll see two things. You'll see podcast and newsletter. Click on the newsletter side. Sign up for it. It's free. Come out. It'll be in your email box every Friday about 5 o'clock. I think it goes out. A lot of great topics. People love it. It's growing pretty good. People really like it because and you can pull out different topics like, I don't care about the Eurozone. Yeah, don't read that one. Read about the unemployment rate. Read different things that make you what you want to know about.
Yeah,
So.
and again, it's just it's I'm going to say more optimistic than a lot of news out there.
Yeah.
And it kind of just brings out the facts rather than the emotional pool that a lot of the news tries to provide. So it's I think a just very informative, very useful newsletter there.
Yeah. And also, too, because we do use as a tease here on the show, generally do 3 or 4 different topics for you. You might say, well, what were they talking about? That the first one was on the rental market and so forth. Well, you might want to go over that again because there it is. So, again, go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Just click on the newsletter side, sign up for free. Also, too, there's a contact thing on the far right. If you want to have questions, you don't want to call in, you can send us an email. Just contact us and say, hey, I want to know about such and such, or I have this question. We'll read it on the air, time allowing. We got a couple here today that are going to do. Phone numbers here. All lines are still open, 833-288-0973. Again, that's 833-288-0973. 0973. Well, this actually came in last week on a newsletter from Jim. He says, Jim from Alpine here. My Saturday mornings are full of other things these days, so unfortunately will not be able to go live with the Wham crew. Can you please look at CFG? I own it, about 3% of the portfolio, and wondering about the future of what, given what I paid for it, 27, is returning a rather nice dividend. Now thinking of buying more, just wondering about its forward viability. Many thanks, Jim. So let's take a look at that there and see what we can come up with. And the symbol, again, I got to put this in here, is where is that? CFG is a symbol. Let's see what we got. Citizens Financial Group. So I'm going to say, you probably pulled it up already, Chase, probably a bank.
I'd assume so. Yeah, it's a regional bank.
Regional bank, yeah. So, and we do like the bigger money center banks and so forth, but there's some viability with these small regional banks. So let's say if Citizens Financial Group is one of those, they are in the regional bank industry. Their float is only 3.4%, 92% institutional owned. We do see they have a PE ratio of 10.5, just slightly higher than the industry at 10.1. Price of sales 2.6 versus 2.2. Price to book value 1.6. That's good. That's half the industry at 3.4. And price of cash looks good as well, 5.5 versus 10.6. Now, the analysts don't seem to like this too much because the PEG ratio, the PE divided by the growth going forward, is 10.3. That is higher than the industry at 8.9. You actually want that lower, not higher. So not expecting, actually probably paying a little bit, maybe too much for the future growth of this company. We do see over the last year, earnings did fall by 22.3%. That was more than the industry, a fall of 6.5%. However, sales did climb by 13.4%. The industry did drop by 1.8%. The 5-year estimated growth rate from the analyst, that is not quite as good as the industry. It's 0.9 for the company, 3.9 for the industry. We do see they pay a dividend of 3.9%. That's very respectable. I like that number. Payout ratio 40%. So that's in line. That's very good. I do see over the last 5 years they've increased that dividend 13.8%. And then look at the balance sheet. It's a financial company, so there's no current ratio. But we do see a debt to equity of 0.7 versus 1.1. That's a positive. Net profit margin 25.9 versus 25.6. That's very good. Return on equity is a little bit low, 7.9 versus 10.8. Chase, what do you got?
Yeah, so looking at the business here, it is actually, again, a retail bank. They operate mainly in New England, the Mid-Atlantic, and the Midwest regions of the United States. So one thing about these regional banks is obviously you want to understand the region, how the business is doing there. Example is we have like a real estate, a REIT in our portfolio where it's kind of more concentrated in the Sun Belt and kind of the South, and I continue to believe that the economy there is going to remain strong. I still sometimes kind of worry about the West. We know that a lot of people have kind of been leaving California. They've been leaving New York. So I'd want to see a little bit more of the economy strength when investing in these regional banks. It's something, I guess, one step further you got to take when you invest in the full kind of concentrated bank rather than a diversified bank across the country. One other thing, looking at the current price here for, again, Citizens Financial Group, it's $43.12. The 52-week high is $55.99. And the low is $32.65. Going forward for the company, I go to December 2024, I do see estimated earnings per share of $5.26. Would give us a target sell price at $87.32. I mean, the valuations on this company are still very, very strong. One other point I do want to bring up is I think their earnings took a hit probably because of loan loss reserves. They had issues there. And then also, too, I was reading the other day about the Fed stress test. This is something that the big banks have to go through. I honestly do not know, because we haven't owned a regional bank in years, if the regional banks have to go through the stress test. I believe they do.
I think they do. I mean, if we were to invest in one, we would definitely know that question. Which, if you do own it, you want to know that question.
Yeah, because I know
answer that question.
I know this year's Fed stress test is more stringent than in prior years as well, and I think it's things like the stock market falls 40%, the real estate market on the commercial side falls 40%, GDP falls by like 8%. I mean, and again, these are just numbers off the top of my head. They may be a little bit different, but they're very dire situations to make sure banks can get through that. The problem with that is it could limit the capital returns that banks are allowed to do, and that may be dividend increases, share buybacks. I don't think they'd have to cut the dividend, but it's just something to kind of keep an eye on. I believe those results come out in June.
Yeah, and it's something that, and I did a segment on KRSI last Sunday, And it's just sometimes I think the government oversteps. I mean, they're making these harder and harder for businesses, and you want them to make sure that you don't have these Wild West banks or just doing all kind of crazy things, having the balance sheet filled with crypto or some like crazy thing like that. But on the other hand, too, like you can't restrict them too much, because then well, who wants to run a bank because you can't make a profit on it? So I've said this many times. I hate when the government goes too far, because many of them have only worked in government their entire life. They have no idea what it's like to run a business, but yet you can try to control a business because of what you think based on no experience.
Yeah, and I mean, Jamie Dimon's the CEO of J.P. Morgan, obviously, and he's very against the heavy regulation on the banks. I'd be willing to say he's for some regulation, but I think over-regulation, he said it hurts the consumer at the end of the day.
Yeah.
And that's who the government's trying to protect, but they're actually hurting them, which is kind of a funny thing. And I wish they would actually listen to a guy like Jamie Dimon and Brian Moynihan, the CEO of Bank of America, like these guys, and Charles Scharf from Wells Fargo, and actually talk to them. But it just seems like there's this headbutting between government and business, and it's like, if you guys actually work together, there might be some good resolutions.
And I don't want to get political, but I just want to say when President Trump was in office, he did talk to the executives, and it made sense to me, because these are your business leaders in the country. I don't understand why every president doesn't want to talk to the business leaders to find out what can we do. Rather than government working against the businesses, what can we do to work together? Because if we work together, we could grow the country much better, as opposed to this fighting and, we're going to penalize you for this and penalize for that. What can we do to help the businesses? And again, I mean, it's just, unfortunately, most of your presidents, most administrations, they don't even talk to the businesses. It's such a shame, because they should be, on how they can help the businesses.
Yeah, well, side tangent there, but I think CFG, I wouldn't be concerned about the dividend there, Jim. I know that's something that you always ask about, so it's I like the business. Obviously, you always got to recommend further research there. Is it a little more concentrated in particular areas? Also, would want to understand their loan portfolio. I do see automobile loans is one of the areas that they derive a lot of net interest income from. So I would kind of want to understand that a little bit more, because I know autos have had some concerns around them given the current interest rate environment.
Yeah, and Jim kind of asked, should he add to it?
It depends on the research.
Yeah, the research. You got more research to do, because based on the numbers, it's like, yes, you should, but there could be other things there you got to understand before you actually do that. So, all right, Jim, I hope that helped out. Phone numbers here, 833-288-0973. That's 833-288-0973. Well, it's time to talk to our financial planner, Harrison Johnson. Good morning, Harrison. How you doing this morning?
Good morning, guys. How you doing?
Good. I like the topic today, because I was wondering this. I've heard different stories. When to file your taxes? Do you do early? Do you extensions? What do you got here for us?
So I wanted to have kind of a public service announcement here, but we'll go into it. So 1099-Rs get sent out usually in January. A lot of people have started to get their W-2s now. The 1099s for dividends, capital gains, and interest usually get sent out in February. I know Schwab is doing theirs on the 17th of this month, I think, so that'll be soon. Tax day this year is Tuesday, April 18th. That's when the actual taxes are due. If you file an extension, you can wait to file for another 6 months, but no matter whether you have an extension or not, taxes are still due on the 18th. So a lot of people now have everything they need to file, and many more will have that in the coming days. But the public service announcement I want to put out there is, a few days ago, the IRS came out and said to hold off on filing your taxes. And the reason is, a lot of states last year, including California, issued stimulus checks to residents. In California, it was called the Middle Class Tax Refund. It was somewhere between $200 and a little over $1,000. And technically, this was a state tax credit that was issued toward the end of 2022. Some got them at the beginning of 2023. But the IRS came out and said they have not determined yet whether or not they will be taxing these checks federally. So it was tax-free on the state side, but it might end up becoming taxable on the federal side. So it might be best to wait a little bit to file until we get more guidance from the IRS on if or how that should be reported. In the meantime, take a look at your income. If you got your W-2s and your 1099s and everything, see if you got any time for IRA, Roth IRA, backdoor Roth IRA, HSA contributions. All those can be done still up until the tax filing date. Or if you've made contributions for 2022 that are not allowed because your income was too high, so the contributions maybe either aren't allowed or not deductible. If you withdraw those before the tax filing date, then you won't have any over contribution penalties or anything like that.
Yeah, I think it is kind of funny. I think the IRS is giving themselves more work here than they need to, and they're going to wait, and then they're going to get this huge rush of tax filing, and then they're going to be behind.
Well, the problem is, the IRS just came out a few days ago and said, okay, everybody, hold on until you file, but the IRS has known that states have been doing this for like a year now. And so they waited an entire year to figure out how this should be handled tax-wise. It just doesn't make any sense at all. So
well, I think
they said that if you've already filed, to not file an amendment yet, but those who haven't filed and got that refund or that tax credit, to hold on to see how that should be filed.
I think what happened is the government said, "Oh crap, we're spending way too much money. We need some more revenue."
and yeah, I mean, there's definitely more revenue that they could get from it. But I mean, relatively speaking,
nothing.
There was a good amount of money that went out. But even if they do tax it, I mean, it's not really going to make that much of a difference federally if it ends up becoming taxable, because it was to get it, you had to have certain income requirements, which means you're usually in the mid to lower brackets anyway. So if it does become taxed, it's not going to be taxed at a super high rate. But I mean, it's just another example of government not doing things on time.
Well, I think it's funny because I thought this administration, I hate to get political, but I didn't think they were going to go after the small guys. And this is exactly
what they're doing. I know.
But, hey,
that's politics.
I know.
It's not the Democrats, Republicans, just kind of politics in general, that they just say one thing and then they go after the little guy, unfortunately. Harrison, and I don't know if you have these numbers, I kind of catch you off cold here, but I have heard that it's better to file extensions and file in October as opposed to do it now. I always do mine early because I like to see what the results are, good or bad. Have you ever seen any numbers on that at all?
I mean, again, whether you file in April or you wait until October, the taxes are still due in April. Mm-hmm. So you have to make sure all the money is actually paid by that point. I know a couple years ago there were some people that wanted to wait to file because some of these rebates that were going out were based on your AGI, and they were using the most recent return that you had. So if you filed a recent return that had an higher AGI, that would disqualify you. So if you waited to file and then used your previous years, maybe that AGI was lower. So there's stuff like that. Usually what happens is people that file extensions just, maybe their tax situation is complicated and they want more time to do it. But again, it's not like you can put off actually paying the taxes until October. So everything has to be paid, and then you can just kind of play around with the filing of it.
Yeah, and it's just that somebody said that the odds of getting audited are less in October because there's so many returns they have by that time frame versus when you file early in like March or on time in April, there's not as many returns, so they can pull your tax return. And it makes sense to me, but I don't know if there's any numbers out there to back it up, but just kind of curious.
I'm not sure. I mean, that in general, there's not a lot of people that get audited anyway. Audits have been going down pretty much for decades at this point. But, that's a good question, Brent. I'm not sure how that's the case. I know, generally speaking, business owners are usually the ones that file extensions because they've got more complicated tax situations with, making sure that their books are all good and they've got all the deductions that they can. Is there different ways to structure depreciation and things like that? So, and then sometimes throughout the year, the IRS will issue guidance on certain things like this tax refund deal. And so a lot of people like to kind of have that extra time to do planning and think about ways to file. But it's to your point, I'm not sure whether that has an influence on your chances of getting audited or not. That would be kind of interesting to know.
And I don't know if there's even numbers out there that would prove that, but yeah, just something interesting. Well, Harrison, thank you very much. We appreciate it. Have a great weekend. We'll see you Monday morning.
All right, thanks, guys. We'll see you Monday.
Okay, bye-bye. Again, that's Harrison Johnson, our CFP, our financial planner. He's on a salary. He doesn't sell annuities or life insurance. He really does a true financial plan to really listen to you, to what you need, how we can make that happen. Get a free consultation. Give him a call at the office, 858-546-4306. Again, that's 858-546-4306. Or you can go to the website and just send them a message to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. All right, phone number's here, 833-288-0973. That's 833-288-0973. Let's go back to our emails here. We got an email from Jeff. He says, I've been looking for a San Diego stock to invest in. I was wondering if you hit a low on the radio show, you guys, could you give me a take on Jack in the Box, symbol JACK? In researching the stock, it seems if they also own Del Taco, which I didn't know. And I don't know if we'll find that today or not. And I don't think it was Del Taco. I thought it was a different.
They had Cadobo, but I believe they also bought Del Taco.
They did buy Del Taco.
Somebody bought Del Taco.
Could have been Jack in the Box.
Yeah.
So, well, let me go over the numbers here for you, Jeff, and kind of look at it. And funny story, I mean, when I came out to San Diego, I worked for Jack in the Box in the corporate office. It's then called Food Maker. So, yeah, it's kind of funny to kind of look at it now and see how far they've come from when I worked for them back in the, that was back in 1983. I worked at the corporate office of Jack in the Box. So let's take a look at numbers at Jack in the Box restaurants. Symbol is JACK. Wow, 9.6% short. That's higher than average. Not terrible, but it is higher than average. We do see that their PE ratio 14.3 versus 36.3. That's good. Price of sales 1.1 versus 2.9. That's a positive. What's not looking good is there's no price to book value. The industry does have a price to book value of 27. So tells me that their liabilities exceed their assets, and you don't have any value there, which could be a danger zone. Could be other things, but you got to look a little bit deeper. But off the surface, could be a problem. Look at price of cash flow, 10.2 versus 20.6. That is good. The PEG ratio, 3.1 versus 3.4, so that's okay. Now, we do see over the last year, earnings for Jack in the Box fell by 22.3% when the industry is up 25.5%. So you would want to find out what happened there. There could be a couple of things. The previous year earnings could have been higher because of something else they did. Perhaps they had some write-offs, but you really want to know, why did the earnings fall by 22% this year? We do see sales are up 27.7%. The industry was up 41.8%. They do have a 5-year growth rate on Jack in the Box of only 4.5%. And I say that because the industry is at 20.6%. So the overall restaurants seem to be doing far better. They do pay a dividend, not a bad dividend, 2.3%. Use 32% of the earnings to pay that out. We also see that, let's see, the balance sheet, current ratio 0.5 versus 1.3, and no debt to equity because, remember, there's no equity. So this is kind of frightening to me on the financial side. When you got a current ratio of 0.5, tells me they can only pay off about 6 months of the current liabilities of the current assets. That could be a problem for the company. So you got to dig deeper in those financial statements. But this is what I call a warning sign before you invest in this company. Find out where they stand financially. We do see that they have a net profit margin 7.9, same as the industry. Return on equity a negative 15.7. That's bad, but the whole industry is a negative 102. That sounds strange. So I'm not liking what I'm seeing here. I'm getting some concerns. Chase, anything good going forward?
Well, first of all, they did buy Del Taco, and they completed that acquisition. It was $585 million. It's actually what they bought Del Taco for. And then actually, I didn't know this. I don't think we've looked at Jack in the Box in years. They actually sold Cadobo back in 2018 to Apollo Global Management.
Wow.
So no longer part of Jack in the Box. So it sounds like maybe they want a new taco company.
they like in that Mexican field, I guess, the Mexican food side.
I guess so.
Although I think Cadobo was far better than Del Taco.
I don't know. I've never had a Cadobo.
Yeah.
I've never had it.
Yeah.
Had Del Taco. My wife loves Del Taco. I always give her a hard time. They're like Taco Bell better and whatever.
Two high-class restaurants
I
you're
know,
going
right?
to.
Right. I haven't been to either one in a while, but I digress. Current price here for Jack in the Box, $77.96. And I remember looking at this. I pulled up a long-term chart of Jack in the Box. And I remember looking at, I think the last time was probably like 2015, 2016. The stock was around like 100, over 100.
Yeah.
And in 2021, it went to like $125, $120 a share. So it's definitely pulled back from those highs again at $77.96. 52-week high, $95.44. And the low, $54.80. Surprised by this. The market cap for Jack in the Box, $1.6 billion. I thought it would be a lot bigger.
Yeah.
So a little surprising there.
And it was when the stock was 95, but now at what you say, it's 77. It's
But even that, I mean, it still wouldn't have a market cap of around $10 billion.
Yeah.
So I'm just kind of surprised by that. But going out to September 2024, I do see estimated earnings per share of $6.36. It does actually give us a target sell price here of $105.58. So the valuation looks good. I see earnings are estimated to grow about 15.1%. It's a forward PE of around 12. So from the valuation standpoint, it looks good, I would say. But the problem is, again, that balance sheet. And one thing that I've just never understood is I'm assuming Jack in the Box has perhaps that franchise model. So you're, in theory, what we call asset light.
Right.
And the balance sheets always look terrible with asset light companies.
Mm-hmm. And that's why I say you got to go look at the financial statements, because we can see one thing here. And we're designed to try to point in the right direction. And we say you got to do more research because there could be other things in there. And they're a franchise company. They used to own a lot of restaurants. Maybe they've been spinning those off for franchises, but these are things you have to kind of look at the restaurant to see. Maybe they don't own any restaurants any longer. Maybe they are truly asset light. I know they did own the corporate building on Balboa Avenue. I believe they're still there and stuff. But I also did notice, too, that the 90 days ago that the earnings going forward have actually fallen 15.5%. So there's something going on there, and this could either be a buying opportunity or a warning sign. What worried me was a current ratio. Now that, the debt can change and so forth, but the current ratio, that's pretty easy ratio to come up with. That worries me. I mean, that's not a lot of liquidity. And you get some type of crunch or something, that could force a company into bankruptcy. And more companies have filed bankruptcy because of liquidity issues than debt issues many times. So something to be careful there. I think it's worth a research. I like it. Could be partly because of the fact that
You like the fajita pita.
Fajita pita. I do like the fajita pita. I can have 2 or 3 of those and not have any calories. I do like those. But I like the concept of the company. I like fast food restaurants. I think they're profitable. I just don't like what's going on with the liquidity. I mean, you got to understand that because it could be a warning sign.
I just pulled up McDonald's, and their current ratio is like 1.7. So it is something that is kind of strange, and definitely something that, as you said, is quite concerning.
Yeah, because when I look at the industry average for the current ratio, it is 1.3. So, and that's why we compare, because we always say a number means nothing else unless you have something to compare to. Well, a 0.5 current ratio versus a 1.3, that's a warning sign to me.
Well, and all of a sudden, they could be fine if their cash flow is still coming in, so you're still paying off those bills and you can maintain it. All of a sudden, that cash flow chokes off.
Yep.
That's where the issue ensues.
Yeah. So I was going to take a look at their cash flow statement. I looked over. We got a couple calls here. So let's see who was here first. Let's go out or down to Chula Vista and speak with Michael. Michael, you're in the Smart Vegetable Brent Chase. How can we help you out?
Good morning. I'm calling about Cigna Corporation, symbol CI.
Okay. And do you hold that or looking at buying it?
I do hold it. I'm looking to buy a little more. It dipped a little bit last week after their earnings release, so I just wanted to see if it was a good time to add to the portfolio.
Okay. Well, let's take a look at Cigna. Again, the symbol is CI. We do see they're in the healthcare industry. Float on the short, only 0.7, so not expected to drop it all there. We do see you got a P ratio of 13.9. That's very good compared to the healthcare industry of 24.1. That's actually healthcare plans industry, so a closer comparison there. Price to sales 0.5 versus 0.7. Price to book value 2 versus 3.3. Price to cash flow 8.6 versus 12.7. The pay ratio 1.1 versus 2.8. So all the valuation ratios looking pretty good here. Now, we do see they reported earnings, and over the past year, their earnings are up 32.4%, far better than the industry, up 12.8%. Sales did increase by 3.3%, not quite as good as the industry, up 8.3%. We see a 5-year growth rate of 11.3%, very close to the industry at 12.3%. They pay a 1.7% dividend. They use about 21% of their earnings to pay that out. Again, a financial healthcare company, no current ratio. Debt to equity 0.7, same as the industry. Net profit margin 3.7, that's above the industry at 3.2, and a very good return on equity of 14.7. Not quite as good as the industry at 20.8, but I like return on equity around 15%. Chase?
Current price here for Cigna, $296.51. 50-week high, $340.11. So it has pulled back from that high there. At the low, though, $218.52. Unfortunately, year-to-date, down 10.5%. I go forward to December 2024, and I see very good earnings. Estimated to be $28.28 would give us a target sell price of $469.45, and that's an estimated growth of 14% over 2023 levels. I mean, that is very nice earnings growth for one of those sexy insurance companies, I guess I'll say. So I like the numbers on Cigna. I think, again, it's not anything that's going to knock your socks off in terms of how exciting their products are. But, again, it's one of those insurance companies we kind of talked about at the beginning of the show that I like their models.
And also, too, they own a pharmacy benefit unit as well. I mean, they're a pretty diversified company on top of what they do. And I do see also, too, that over the last 9 days, the earnings are expected they actually rose by 0.2% on the estimate. So a lot of times you see that dropping now. They're about flat, but still good at, what do you say, 28, 29?
$28.28 is the estimated earnings.
Yeah. So we like it. And I think you said you own a little bit. Think of adding to it. How much percentage-wise you hold in the portfolio there, Michael?
Maybe just about 2 or 3%. So I might bump that up a little bit.
Yeah, you can bring that up there, and I think down the road, and it could always pull back a little bit, but I think down the road, 2, 3, 4 years, you'll be happy about Cigna.
And I believe they're increasing their dividend. They buy back a good amount of stocks, so they're very shareholder friendly. I think it's I like it.
Yeah. All righty.
Thank you. You guys have a great weekend.
You too, Michael. Thanks for calling. Bye-bye.
Bye.
All right, that opens the phone line, 833-288-0973. That's 833-288-0973. Let's go out to San Diego and speak with Anthony. Anthony, you're on the Smart Invest Show with Brent Chase. How can we help you?
Hey, good morning, guys. I wanted to see what you thought of Tyson Food, TSN. It took a little bit of a hit on earnings this week. I don't own it yet, but I was just looking to buy.
All right, well, let's take a look at Tyson Foods. They're in the farm products industry. Only 2.3% short on the float, so not much there. Expected for it to go down more based on the analysts there. We do see a P/E ratio 9 versus 10.2. That's good. Price to sales 0.4, same as the industry. Price to tangible book value 7.5 versus 9.9. And price to cash flow 10.8. That is below the industry at 19. And the PEG ratio going forward, very good, 1.9 for Tyson Foods. Well below the industry at 9.1. Now, we did see the earnings per share fall by 33.6%. The industry is only down 0.7. Sales actually climbed by 8.3%. Not quite as good as the industry, up 18.5. The 5-year growth rate for Tyson Food is 7.5% versus 5.2, a positive there. You get a pretty good dividend, 3.2%, and they only use 27% of the earnings to pay that out. Look at the balance sheet. You got a current ratio of 1.8 versus 2.0. Debt to equity only 0.4 versus 0.7. So they're really keeping their balance sheet pretty strong at Tyson. Net profit margin 4.5 versus 4.1, and return on equity 12.4. That is slightly under the industry at 15.1. Chase?
So current price here for Tyson, $60.39. The 52-week high is $99.54, and the low is $59.38. So right around that 52-week low there. Going forward for Tyson, though, I go to September 2024. I do see estimated earnings per share of $5.47. We'll give you a target sell price of $90.80. And obviously the valuations look very good on it. I know this company had a lot of headwinds in the last quarter. The CEO talked about how pork, beef, and chicken all moved against them, which having that kind of diversified portfolio most of the time hedges that. Very unlikely that happens.
And when you say moves against them, you mean that they went down in price, which is positive for inflation for the consumer, which we look at stuff like that. Also, too, they have been fighting with the bird flu, which actually I found out that the bird flu affects the birds more on those laying eggs than for chicken. I think on the Super Bowl, I think it's going to be like 1.8 billion wings served this weekend or something crazy like that. But it's a good, solid business. They got some headwinds. I think the CEO said it as well. You get a nice dividend. I think it's a good company for the next 2-3 years.
This is the type of company you like to buy. When you listen to the conference call, they actually talked about how they were kind of wrong in placing meat in particular areas. Well, then what happens is they had to pay extra money to move that meat out of there or severely discount it. that had a huge impact on earnings. That's a very fixable problem. All of a sudden, you fix that problem, that boosts your margin. So I think this is a company short term, again, going to be quite volatile, but long term, I think it's very, very intriguing.
And Anthony, Chase brings up a very important part, and for you and all the listeners, a fixable problem. That's what you try to find. They have a problem? Can they fix it in the next 12, 18 months? We believe the answer to that question is yes. So that's what we like about Tyson Foods. So we're going to say it's a buy. All righty?
Great. Thank you, guys.
All right. Thanks for calling. Bye-bye. All right. Well, I was going to say it opens on the phone line, but we only got a few minutes left. So one thing I do want, since we got some time here, Chase, I'm sure you've seen, and I still call it Google, but Alphabet.
Yeah.
I mean, they are down dramatically, and I just think they're doing a good job. So I want to take some time to actually look at their numbers to see what we see, because maybe with all this big fall, maybe it's a buy on Alphabet, symbol GOOG. They're on the Internet Content and Information business. We do see a PE ratio of 20.8 versus 24.7. Price of sales, 4.4, same as the industry. Price to tangible book value, 5.4 versus 38.5. And then price of cash flow looks pretty good as well, 13.6 versus 15.8. Now, they do have a good PEG ratio. Sometimes on technology companies, you don't see this. The PEG ratio going forward, 1.3 versus 19.2. Now, they did experience a decline in their earnings over the past year of 18.7%, but the industry lost 30.2% in their earnings. Sales are up 9.8%, industry down 0.5. They have a 5-year growth rate on their earnings of 15.5 versus 10.1. They do not pay a dividend. Maybe that can change in the future, but not yet. We do see on the balance sheet, current ratio 2.4, same as the industry. Debt to equity is only 0.1 versus 0.3. They have a net profit margin of 21.2 versus 17.3, and return on equity 23.4 versus 22.3. Chase, what's it look like going forward?
Yeah, so I'm looking at GOOG as the symbol I'm looking at. I know there's two different share classes, so I'm just going to go off of those numbers. But the current price for that share of stock is $94.86. 52-week high is $144.16, and the low is $83.45. I see year-to-date stocks actually up 6.9%, so done okay there. But over the last 1 year, down 31.6%. When I go forward for the company, I go out to December 2024, I do see estimated earnings per share of $6.10. Actually does give us a target sell price here of $101.26. So wouldn't be a buy necessarily, it'd be in our hold category, but this is the first time that I can remember one of these big tech companies has actually registered a target sell price higher than the current price for our metrics here.
And what was it? I was looking at something else. What was that?
101.26.
Okay, so still not a buy yet in the whole category. We need it for it to drop a little bit more, have the earnings go up. I did want to point out, too, I want to take a quick look at the cash flow statement. And this is a company that, if we can get it for the right price, we're very excited about it. Their cash flow per quarter is like $23 billion. I mean, now you go back to September 20. Now, I guess that was COVID. It was $17 billion. And I was going to look at their cash that they have on hand here as well. Let's see, their cash balance, $113.7 billion in cash. And again, they generate $23 billion a quarter in cash. I mean, I would love to buy this company. I think they got great products. They're getting beaten up for this new AI or whatever.
They had a couple different. YouTube actually declined in terms of ad revenue, which was a problem. They have a few and antitrust is another issue with their search monopoly. I mean, there's some government headwinds in terms of regulation. I would love to see those headwinds pick up, because that's what could pressure the stock more, and you could get it on sale.
Yeah, I would probably say a good price to buy it would be just going to throw a number, 80, maybe 85.
I was going to say 70 would give us about that 30%.
And I know you said YouTube numbers, advertise or sell.
And I don't recall if they fell, but I remember they missed estimates, and they were just not having the same type of growth that, YouTube a couple years ago was like, oh my gosh, it's this huge growth engine, and it's not that way anymore.
And we've talked about that. As those numbers get bigger, you're not going to have those magnificent growth of 20, 30, 40% because the numbers are bigger. It's hard to grow those numbers at those rates.
And Google's also in the cloud. Don't forget about the cloud.
Yeah, well, that's right.
They're still growing there, but again, not at the same rates that they were. Growth is decelerating, which the market does not like to see, and that's why the valuations and the multiples are contracting on these companies.
Yeah, and it's one. Oh, it's one that we would like to buy, but just not yet. Well, this is Closing Bell. Thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs or have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. And be sure to visit our website, smartinvesting2000.com. That's smartinvesting2000.com. And remember to sign up for the newsletter there. It's a great newsletter. You're going to love it right there at smartinvesting2000.com. Well, have a great day. We'll talk more next week right here on the Smart Investing Show.
So amusing to think that I did all